We've all seen those people on the internet showing off their luxury watches and Lamborghinis, talking about how they made all their money from day trading. But what is day trading really? And how are these people actually making money from tiny movements in markets? Financial markets move constantly throughout the day. Prices go up and down because millions of people, institutions, and algorithms are buying and selling at the same time. Day traders are people who try to profit from short-term price changes that happen during a single trading day. Instead of holding investments for years like traditional investors, they might hold something for hours, or sometimes even minutes. They spend time studying charts, patterns, and market behavior, trying to predict whether a price will move up or down. But to understand how someone can actually make money doing this, you first need to understand the core game. The objective itself is actually pretty simple. All day traders are trying to answer one question: is the price going to go up, or is it going to go down? If a trader believes a price will go up, they go long. Going long simply means buying something with the expectation that you will sell it later for a higher price. For example, imagine you buy a pair of limited sneakers for $100. Later, the price goes up, and someone is willing to pay $102. If you sell them, you keep the $2 difference as profit. That sounds small, but traders often trade large amounts or repeat this process many times. But traders can also profit when prices fall. This is called going short. Shorting usually involves borrowing an asset, selling it immediately, and then buying it back later at a lower price. Another way to think about it is like borrowing your friend's textbook, selling it for $100, then later buying the same book when it's on sale for $80, returning it to your friend, and keeping the $20 difference. So in theory, traders can make money whether the market goes up or down. Sounds easy, right? Well, here's where things start getting interesting. Day traders repeat this process many times throughout the day. Most individual trades only capture very small price movements, sometimes just a few cents. But repeated over many trades, those small gains can add up. To decide when to enter and exit trades, many traders rely on charts. Charts allow traders to see how prices have moved in the past and try to identify patterns. One of the most common chart styles traders use is called a candlestick chart. Candlesticks show how price moved during a certain time period, including the opening price, closing price, highest price, and lowest price. Traders look for patterns in these candles, hoping they might give clues about what could happen next. But what exactly are these assets that traders are buying and selling all day? There are a few major markets where most day trading happens. One of the biggest is the stock market. Stocks represent ownership in companies. When you buy a stock, you're buying a small piece of that company. The price moves based on things like news, earnings reports, and overall investor demand. Another massive market is Forex, which stands for foreign exchange. This is where traders buy and sell currencies against each other, like the euro versus the US dollar. It's actually the largest financial market in the world. Then there is crypto, which includes digital currencies like Bitcoin and Ethereum. Unlike traditional markets, crypto trades 24 hours a day, 7 days a week, and prices can move very quickly. On top of these markets, traders sometimes use financial contracts called derivatives. The two most common ones are futures and options. These are basically contracts that follow the price of something else, like a stock, commodity, or currency. They let traders try to profit from price movements without actually owning the thing itself. They're popular because they allow traders to control large positions with relatively small amounts of money. But regardless of the market, the core game stays the same, predicting which direction the price will move. And that leads to the most important question. So where does the money actually come from when someone wins a trade? The answer is surprisingly simple. Every trade has two sides. For every buyer, there must be a seller. One trader believes the price will go up, while the other believes it will go down. When the price moves, one of them is right, and the other loses money. In many cases, trading profits simply come from other traders on the opposite side of the trade. When one trader makes money, another trader somewhere else is taking the loss. The market itself also has other participants. Some traders are individuals trading from home, while others are hedge funds, banks, or large trading firms managing massive amounts of capital. And sometimes, the trader on the other side of your trade isn't even a person. It might be an algorithm. Many trades today are executed by computer programs designed to analyze markets and place trades automatically. These systems can react to market changes extremely quickly, sometimes in milliseconds. Even when traders win or lose, the financial system itself still makes money. Brokers charge commissions for placing trades on behalf of traders. Exchanges charge small transaction fees every time a trade happens on their platform. Market makers profit from the bid-ask spread, the gap between buy and sell prices. That gap is how they make money on each trade. So yes, people can make money day trading. But the reality is that it is far harder than social media often makes it look. Markets are extremely competitive environments. You're not just trading against beginners. You're often competing against professionals who have years of experience, advanced software, and massive amounts of capital. Large trading firms run powerful algorithms that can analyze data and execute trades in fractions of a second. Because of this competition, many traders struggle to stay consistently profitable. Small mistakes, bad risk management, or emotional decisions can quickly lead to losses. That is why discipline, patience, and strong risk control are extremely important for anyone trying to trade. So that is the basic idea behind how day traders make money. They try to predict short-term price movements and profit from the difference between buying and selling prices. They trade across markets like stocks, forex, and crypto, sometimes using contracts like futures and options. And while it is possible to make serious money doing this, it is also one of the most competitive environments in finance. Some traders spend years learning strategies, testing ideas, and developing systems that they believe give them an advantage. But even then, success is never guaranteed. And behind all the screenshots and luxury lifestyles online, there is a much more complex reality happening inside financial markets every single day. Because in the end, for every person who wins a trade, someone else on the other side just lost it. And if you enjoyed this video and want more simple explanations of how money and markets actually work, consider subscribing. And if you found this helpful, leaving a like really helps the video reach more people. Thanks for watching.